You walk into your annual performance review. You hit your quarterly targets, your manager smiles and congratulates you on a $5,000 base salary increase. Your brain immediately starts dividing that gross number by 12. You imagine a slightly better apartment, leasing a newer car, or finally going out on weekends without checking your bank balance. Is a structural illusion designed to keep workers perpetually dependent. To understand the trap, we have to look at the mechanics of the American tax code. A new raise lands entirely on top of your existing income stack, subjecting it to your highest marginal tax rates. This diagram shows exactly how a $5,000 raise breaks down. First, the federal government takes its marginal cut, typically 22 to 24% for the average middle-income earner. Next comes the Federal Insurance Contributions Act, or FICA. Social Security and Medicare deduct a flat 7.65% right off the top. Then, in states like New York or California, state and local withholdings carve out another 4 to 9%. Your $5,000 raise actually delivers about $3,100 in take-home cash over the year. That is roughly $60 a week. This triggers the lifestyle ambush. Because you see a $5,000 bump on paper, you feel justified moving into an apartment that costs $250 more per month. You end up working harder and paying more taxes, yet finding yourself with less breathing room than you had 12 months ago. Standard personal finance advice focuses on skipping $5 coffees, but that strategy relies on hundreds of daily micro-decisions that create cognitive fatigue. This pie chart shows the reality of household spending. Housing and transportation alone consume over half of the average take-home paycheck. Optimizing these big three expenditures once provides a massive mathematical win for the entire year without requiring daily willpower. When you eliminate $5,000 of annual waste, like splitting rent or driving a paid-off vehicle, that entire amount stays inside your bank account. Expense reduction is completely tax-exempt. Unlike a raise, every dollar you cut is a dollar you keep. To take home $5,000 of clean, usable cash through a corporate raise, you would actually have to negotiate an increase of nearly $8,500. In the early stages of wealth creation, playing defense on your balance sheet is 30 to 40% more efficient than playing offense. Optimizing the big three is a strategic sprint to secure $25,000 in a high-yield liquid account. This buffer represents 6 to 12 months of basic survival costs, the weaponized operational freedom required to dictate your own terms. This runway gives you the leverage to say no to toxic 70-hour work weeks without fearing immediate financial ruin. It provides the mobility to walk away from predatory rent increases because the funds to relocate are already sitting in your account. Operating with zero liquid buffer guarantees a life of continuous structural vulnerability. The next time a colleague brags about securing a nominal $5,000 raise, listen quietly. You know the hidden reality. Half of that money will vanish into withholdings, and the rest will likely be swallowed by invisible lifestyle creep. Financial strength is built through the quiet discipline of keeping what you make, providing security that a loud, performative salary can never match.